up,
quite the
Stocktwits?
dancer.
Yeah, what's up, Stocktwits Nation? I can assure you, you have not overslept and are not living in a nightmare. That is real, and unfortunately, you had to see it. So, welcome. Good way to start off your Monday morning. As you can see, normal hosts Shy and Katie are out today, but we've got myself. Those who don't know me, I'm editor-in-chief of Stocktwits. Fill in every once in a while here. We've got our AI whisperer, Michael Parekh, holding down the fort with me. So lots to talk about this week. Let's just jump into it. I think first thing kind of on the radar is the market's trading at all-time highs, right? Despite all of the reasons it should go down. And then one of the key reasons I keep hearing for why the market's trading higher is window dressing. It's the end of the quarter, last day of June. Is this a real thing, Michael Parekh? You've been on the institutional side. How does this work?
Institutional side for decades, correct? This market is basically, and what's going on today with everything that's going on around the broader context is underlining the notion that two opposite things can be true at the same time. You've got markets at all-time highs. You've got tariffs at all-time highs globally. And the market is choosing to look through that for now for some of the tactical reasons you're talking about, right? End of quarter, a lot of the stuff around that. Obviously, a lot of attention this week on the big budget bill that's going through, and the street has basically adjusted to what's going to come out of that. But I think in the next 3 or 4 weeks, there will be a refocusing in on the other issues that are very real. You saw Canada, just the whole Canada thing come up. So it's just been shoved into the closet for a little bit. But I think you do have two sets of worries here to worry about.
For sure. And I, just for the audience, right? When we talk about window dressing, what does that look like from a portfolio perspective? Is that just like a manager saying, hey, I underperformed this quarter. I didn't have Palantir in my portfolio. Let me buy it so that, at quarter end, I can mark that I owned it, and then people don't get mad at me. Is that generally the thesis?
It's less the mad at me. It's more relative performance game, right? You basically, you get a chance to reset the clock. You're starting the lap all over again. And now you've got the new lap to start. So we just reset. I can take whatever ugly losses I need to. That's now history. I've done my relative benchmark. So I'm either looking good or not looking good. And I've got to now just perform for the second half of the year. And by the way, the second half of the year from a financial institutional point of view, that's the big gorilla, right? Because we're going into the fall season, Christmas season, etc. There's a lot of repositioning, pre-positioning around that. So yes, that's a big piece. Now, the one other thing I'll just underline, the market has changed a lot in the last 30 years. In my day, when I was at Goldman Sachs on the institutional side with research and equities, most of the trading was active management trading by institutions. Today, over half the trading is passive funds and so on. So there's also that element as well. There's algorithmic pre-positioning and repositioning, etc., that one has to also keep in mind, and that is somewhat different than what we're talking about in this context. But there are a lot of institutions that say, okay, we'll take these losses, take a position in these sectors, and you see a lot of aggregate index buying, sub-index buying, and selling as well.
Yeah, and speaking of kind of retail and that money flow, it's the end of the month, right? Like I get paid today, hopefully. Shout out the Stocktwits finance team for getting my paycheck on our way. But I'll be buying stocks today. I got my 401k contribution. I've got some additional funds that
there you go,
transfer to my brokerage. So a lot of tailwinds right now for stocks, and it's a slow week in the market as well. So unless there's a major catalyst, people are not coming back from vacation this week unless they absolutely have to. So should make for an interesting week. Despite it being slow, one person that is not at the beach is President Donald Trump. He had a busy weekend in terms of just overall discussions and policymaking and the big beautiful bill. So let's run through some of that stuff. First off, Friday we had Trump canceling trade talks with Canada, basically saying, hey, we're not making enough progress here. We're kind of done with it. Last night, we saw um, Canadian, the Canadian PM come out and basically saying, hey, we'll rescind our plan to tax US tech firms and we'll aim to have a new deal by July 21st. So what does this mean for those who aren't familiar? What were they taxing us for anyway? And how does this kind of work? And does this really matter for US tech firms at all?
It's a subtle but an important point that what Canada was bringing up in terms of digital taxes is something that the Europeans also did vis-a-vis the U.S. as well, and basically talks to the reality that the U.S. Trade relationship that the administration talks about is just in the context of goods, manufacturing, etc. The reality is that given the size of the U.S. economy, which is the biggest in the world, 30 trillion, etc. Over the last 30 years, the reality is most of our bread is buttered on the services side. Software, everything, and software is part of this. So EU, in the negotiation in horse trading with Trump, basically said, "Oh, we'll do digital services tax. We'll tax the stuff that you guys really have a huge surplus on, just as a negotiating tactic on the manufacturing stuff that you're beating the bejesus out of us." When in terms of putting a 10% tariff on every physical good with every country in the world, recognize, as you know, Tom, that rate is 2 or 3 times the rate of Smoot-Hawley in the 1930s, which 5 years later led to the Great Depression. We are still at tariff rates that I think the market, looking out over the next 18, 24, 36 months, has not internalized, because at 10% is. Remember, when Smoot-Hawley went, trade as a percentage of the global economy was a third of what it is today. So we, as a country especially, are far more dependent on this. So to Canada's point, they said, oh, you know what? This is just horse trading going on. Trump wants to deal directly with Besant and so on. So we'll throw in the digital tax, knowing that it'll have their opportunity to ratchet it down. Gotcha. And this is also a play on both sides for media attention. For Trump, talking about this from a digital tax point of view on Canada and cutting off all trade is perfect going into the weekend before the big vote is happening on the budget, which is going to be $3+ trillion of stuff. He doesn't want the media to talk about that. So the media can then focus on the Canada-US kerfuffle. And so this is day-to-day media PR management, and the media typically falls for that, and the business goes on. Having said that, to your earliest point, portfolio managers are not that oblivious. They're absolutely focused on the reality of what happens when we really ratchet up or cut all trade with Canada, our biggest trade partner. Over the weekend, Trump threatened shutting down the entire auto industry in Canada, sounding like it's Canadian auto companies that we're buying. No, they're all U.S. auto companies making their stuff over there and bringing it back in pieces and so on. It's really saying, I'm going to beat the crap out of my own head if you don't do what I want. And that's business people, market people, investors know the real game. But the day-to-day headline stuff doesn't, and the headlines are what Trump traffics in.
It's the difference between posturing and reality, and so I think
correct.
The market still hasn't really seen it in the hard data. We're all still speculating what is going to happen. So I know there's a lot of conversation around, will we start to see this in the hard data this summer? And I think the longer these tariffs are in place, the more likely that is. So.
We're already seeing some of those clues in terms of some of the trade data, some of the shipment data, Long Beach, etc. It's still off a cliff. Stores are going to be if you look at the toy industry data, the prices are already going up way before Christmas. The availability of your favorite toys is through the floor. Go on Amazon and try and order some of the things you've normally tried to order. You're going to see 2, 3, 4 weeks. Anecdotally, a lot of my orders on Amazon, I'm getting messages back. Oh, by the way, this thing you ordered for a 2-day delivery, 3 days ago, it may be another 2, 3 weeks.
Wow.
Okay, those are all clues. of what's going on. They can't get those things shipped over here. I'm having electronics, as I'm a gadget freak. I'm having electronics that I normally, I buy a ton of little gadgets or this and that from. Guess what? Most of it comes from China. Half of them, I get a shipping announcement. You'll get it in the next day and a half. Then I'll get a thing that says, "Oh, your order has been sent back." Why? Because of these tariff things in Long Beach. The buyer doesn't want to pay the tariff taxes. So guess what? That thing gets shipped back. I have to reorder it. And I just got an electronics order from a company called B, which makes these AI voice monitoring things. I was supposed to have gotten it 2 months ago. It got shipped back twice. So what I'm just showing you these anecdotal small examples, which is a picture of what's going on across all goods. Because remember, 60-70% of the things, not just electronics, but clothes, shirts, apparel, all from China, and it can't get shifted around. So yeah, we can manage around talk around from a media point of view. Oh, let's not worry. Stock market's at all-time highs, but the stock market, to your earlier point, everyone is repositioning for Christmas. So guess what? In the next month, they're going to start to focus what Q3 and Q4 is going to look like. And when the analysts, which was my old job, start to look at their bottom-up industry, and they're saying, oh, the retailers are not going to have, they're going to have a third less inventory. And the pricing of stuff that's it's going to be 15% higher. Guess what? The consumers are going to be more parsimonious in terms of how they're spending their money, and that's going to come in.
I think that's the disconnect, right? Because people are waiting for signs of like going to Target and not seeing the item they want there, or seeing the price increase a lot. By the time we see that or hear it in a Target earnings call, it's already way too late.
It's too late. It's too late. The stocks will have been down,
and then
correct.
The company will just be positioning for the worst and trying to manage through that. So yeah, certainly an interesting time.
So yeah, so I'm not a bull or a bear. I'm a big believer in passive investing if you're not a professional, etc. But all of this means that the stock market's at all-time high thing needs to be looked at,
through
just
a slightly different lens.
3 steps back and just take a look at the bigger picture and just say, because you're seeing, cars rushing into mountainsides. Or planes running into mountainsides, and you then say, okay, when is it going to pull up or not?
Yeah, that's why I enjoy our conversations, because so much of what I do day to day is dealing in the here and now and what's happening with prices. But you're able to take a step back and remind us of like, hey, there's a larger timeline here that still matters. So speaking of that, let's get into this big beautiful bill situation. So sounds like based on your earlier comments, you're not a huge fan of kind of the positioning of this. I think in general the idea is it's going to increase the deficit by a material amount both next year and the next 4 or 10 years. Trump's positioning is essentially, hey, we still need to get reelected, and also we're going to grow our way out of the deficit, so don't worry about it. I think he had a Truth Social post or something to that effect over the weekend. So, what are your thoughts there, and how is the market kind of interpreting this beautiful, bold thing that he's put out there?
No, I look. It's all kabuki theater, all shell and games. Right now, just 2 days ago, the Republicans realized they need to get certain number of votes under the 50 threshold, and so instead of the 60 thresholds, they're literally going to use a technique that most market observers will not focus on, but they're basically going to wave a wand and say, oh, this $3 trillion deficit, because 70% of this is the extension of the tax benefit that was supposed to expire, that doesn't exist because this was existing legislation, so we can do it with the 50 votes in the Senate instead of 60 votes. And my point is, all of that list, they'll get it through. They'll horse trade their way through. But the reality of what we read about in the papers of what the broader impact is on the U.S. economy, which is 70% consumption, when this country spends over 20% of its GDP on healthcare, 2x that of every developed country in the world. You go to Korea, you go to Europe, etc., less than 10% of GDP. Well, what does that mean? If you're going to cut Medicare benefits don't technically cut them, but you make it difficult to remain eligible for it. If you go look at the detail, once the stories in the next 6 months are going to be people ripping their hair out because they can't get to anyone on Medicare on the phone, and the eligibility things are just going to cut them off. And it's 15 to 20 million people. Well, guess what? If 15 to 20 million people get cut off, okay, that means not only they drop off, and maybe the one party doesn't care about that, but most of those people impacted are lower income people. Majority of them are actually in the rural states, in the red states. And majority of them are basically getting their services in hospitals and healthcare institutions whose budgets are being cut. And so employment's going to go down. There's a ripple effect on consumer spending on everything from hardware to whatever. And all of that, there's no way to avoid it. If you cut federal money, that's 20% of the US budget going to healthcare, let's say down to 5-6% in this slash and burn way, so you can fund the tax benefits on the other side. That, I mean, there is, it's logic. It's like, as Spock would say, it's logical, right? And there's no arguing around that. And so
I think the other piece, and this is kind of what you're outlining, right? There's a major benefit for, the upper middle class and the wealthy who are not going to spend the money. They're going to invest it. They're going to spend it. They're going to save it. And then at the bottom end, you're cutting fiscal stimulus for the people that will spend it. And so, it's kind of a double whammy where, you're just reallocating resources into the pockets of people who don't need to spend it.
Look, one of the best entrepreneurs who was as right wing as they come. He was the Elon Musk of his day, in terms of the biggest car manufacturer in the country, in the world, and also very supportive of right wing side of things, was Henry Ford. Henry Ford realized that his car, which cost a few $1,000s, the Model T, he needed regular people to be able to buy them, and that's why he raised the minimum. He raised the wages for the people in his factory so they could then turn around and borrow money to buy against their paycheck his car, which allowed him to become Henry Ford. My point is this: look, we, regardless of which side of the, look, I've been on the Republican side for a long time as a capitalist, and Goldman Sachs and all this other stuff. But the reality is, you got to make the system work for everybody, because that's where the bread is buttered for the whole country. And if you start to really hit people in healthcare, which is already an inordinate amount of their expense today, and their ability to get coverage, and then you hit the thing with tariffs that are 2 to 3 times higher than Smoot-Hawley across the board, regardless of what you even do with China, that means people who live paycheck to paycheck, which is, by the way, about 50% of the U.S. economy, they're going to be in a tough place. And what are they going to do? They're going to shut down. And by the way, we haven't even touched on immigration. I'm in Texas. Most of my friends who are in construction and building and so on, third of their workforce is gone. They can't. If I have a friend who's building a couple of houses. His timeline schedule has gone up by 6 months because they can't get the people to put the shingles on the house. There's no one there to work it. Then I'll point you to all the ice raids in the farms in California and around the country. There's no workers to pick the vegetables. So guess what? Forget about egg prices. We're going to see this in the news. We'll be on one of these shows in a few weeks, and we'll talk about lettuce prices and tomato prices and so on, because they rotted in the fields. There was no one to pick them. There was no machinery. The robots are not here yet. The robots will not be here for a very long time for a whole bunch of reasons. And so, all of this is real stuff, and it doesn't care whether who one wears a red hat or a blue hat. It's the economy.
Rebecca Patterson, she was the former CIO of Bridgewater. She had a great post on LinkedIn this morning, basically outlining, what she's seeing, and basically outlining a rough second half of the year in terms of growth. So, her prediction, or the way she was framing it, is that what we're seeing in Q2 might be the best for a while. So if that's the case, it's quite not concerning, but interesting to see the market sitting at all-time highs. And
No,
also the other thing I've been talking about is what's driven this market over the last couple months. If you look at Mag 7 performance versus the rest of the market, breadth is certainly expanding. Certain stocks are certain themes are working, but a lot of the heavy lifting has been done by the Microsoft sitting at all-time highs, Tesla back at all-time highs.
Yeah.
So outside of Apple, there's a lot of strong performance in those mega cap names, which has helped buoy the market. I mean, Nvidia last week new all-time highs, so that has been a major tailwind for the second quarter.
No, agreed. And so just to finish up the point on the other conversation, which ties into your current topic of Mag 7s, look, in general for the country right now with the markets at all-time highs, it is the best of times, worst of times, to do Dickens stuff here. And number one. Number two, you don't have to listen to people like me necessarily on that. Just listen to Elon Musk, who, until a few weeks ago was Trump's closest ally. And you look at his Twitter feed in the last couple of weeks, especially the last few days going into the vote on this bill. And his language couldn't be clearer. This is a catastrophe, this bill. This is going to really shred. And he's coming from the perspective of the balancing of the budget stuff, but also now he's also focused very core on energy. Remember, his whole reason for his Tesla thing is clean energy. We need alternatives, solar, wind. Texas, which is where I am everyone thinks of Texas as an oil and gas state, which it is. We're one of the biggest states to contribute to America, going head to head with Saudi Arabia on energy on a global basis, is the largest producer. But a third of our stuff is renewables, wind, solar. You go to West Texas, it's basically windmills as far as you can see. And guess what? Ideologically, this bill has stuff that shreds, just like a
the solar stocks got killed a couple weeks.
Gone. And we can talk about it from a specific stock segment point of view, but in the context of backup energy, front energy, capacity, etc., energy prices are going up, and not just for your manufacturing, which, by the way, we want to bring back. So guess what? If you want to bring back manufacturing, you got to bring really low cost energy at scale available, not just for your data centers, but to manufacture anything you want, chips or clothes or whatever. All those prices are going up. Okay, so I worry about the inflation inputs over the next 6 to 12 months if this doesn't change. Now, the reality is, the administration always uses this as negotiating tactics. Their strategy is put the high sticker price up top. Everyone gets shocked. 150% tariffs on China, then bring it down to 10, and then everyone says, "Oh, it's only 10," and then get relieved and give in on the thing. The reality is, even the 10 is too high, because guess what? The normal rate of tariffs on energy or anything is 2 or 3%. That's what made the world where the U.S. is the biggest economy in the world, and at 30 trillion, and the biggest one is China, over 10 to 12 trillion behind us. Okay.
Yeah. And it's kind of like very similar to the low or zero interest rate environment on the monetary policy side. Now we've gone the opposite way on the fiscal side, where raising rates in a sense across the board for all these countries. So
and Elon is saying it. So don't listen to me. Listen to the guy who's been actually Trump's right hand person for a while now, saying, "Hey, guess what? I didn't think." I don't know why, by the way, he's picking now, right at the 11th hour to jump up and down and put it on his Twitter feed with 220 million followers. He's known this for a year or more, but this is the time he's choosing to rail against it. But it's a voice that needs to be heard if you're, concerned about the markets and the economy, especially on the energy side.
Yeah, absolutely. So a lot of potential headwinds for the second half of the year. Market looking past it right now. Like you said, no matter what the news is, we're looking at the positive side. When that will change, who knows? Only other thing from the weekend, Trump talking about having a very wealthy group of people ready to buy TikTok. So I'm honestly so tired of hearing about TikTok. Like, it's being banned, it's not being banned, we're buying it, we're not buying it. What's your read here? Is there anything to talk about until this is finally, solidified?
Yeah. So, look, Trump, just like on crypto, he did a 180 on TikTok, right? A couple of years ago, he was so anti-TikTok. Then he realized
Yeah.
TikTok was actually help him get votes in the election. And more important, one of his largest supporters is one of the largest non-Chinese investors in ByteDance and TikTok, and is part of this. And also, a lot of his supporters all want to throw in their hat to buy the U.S. part of TikTok. So yes,
Yeah.
deals have been brewing. So if it was just a normal corporate deal, then we would have seen this happen. But this is what the third extension Trump has had to put in terms of the 90-day extension on when TikTok is banned. Okay, so it's almost like the budget. We just punt it down the road, keep going, etc. And by the way, TikTok in general is actually good for America, good for social media competition, great in terms of providing a livelihood to tens of millions of creators, etc. So it's all a net good thing, I view it as. But having said all that, Trump, even in this, where he just talked about TikTok a couple of days ago, he actually said it will most likely need China and specifically Xi's approval, which it will, because China has a golden share in ByteDance, and nothing happens without that. So I think what they're really trying to set it up for is a horse trade around the broader trade thing that's going on with Xi, because they want a bunch of things against us. Fewer restrictions on Chinese student visas, lower tariffs, obviously. There's a bunch of horse trading to be done. So what he's intimating is that there is a bunch of things in the works, but because the U.S.-China thing is still also focused on the broader trade issues, the TikTok stuff has to be negotiated within that whole bulk of sausage meat that needs to be processed. And so this will get figured out. I think it's a 50-50 that it's done in 90 days. I would be surprised to see a fourth punt on TikTok, going into the fall, just because this thing is part of a bigger ball of wax.
Gotcha.
By the way, it also involves Tesla, because Elon has huge interest. We have three major U.S. companies, only three, that have a dog in the race in China, manufacturing-wise. Apple is obviously the exhibit number one. Tesla is number 1 or 2, and Nvidia is number 3, because they still, that's still 15-20% of their market is China. They've been totally cut off. Nvidia already took a $5 to $8 billion charge, depending on how you count it. They're losing $15 to $20 billion this year on that. I mean, the amount of revenue Nvidia is going to lose in China as a business is more than the freaking revenues of Boeing. I mean, when you think about it as a U.S. versus China trade thing, we're really cutting off our nose and ears to spite our face in terms of what we're doing on the chip curbs and so on. And that's part of the horse trading that China needs to make sure they can compete. I mean, this week also the other part of news was DeepSeek, which is China's now exhibit number 1 on their ahead on AI, open source AI. DeepSeek said we are not on track on our next version R2 of their language model, because we can't get enough of even the China sanctioned chips from NVIDIA. And so they're feeling the pain, and China knows that. So there's horse trading. So there'll be some sort of a trade that says allow certain NVIDIA chips, we'll allow TikTok deal with your friends, and that'll be a small piece of the broader trade accommodation whenever it comes, if it comes, in terms of US-China. So that's where TikTok is. In the meantime, we get to doom scroll on TikTok every day, and I spend my half hour a day on it, and it's wonderful. TikTok, by the way, just to add one more point, for young people, it's become the alternative to Google. That's where they search for everything in their life. on TikTok.
Yeah,
We don't realize it.
It's a news and information source.
It
You know,
is. It's not just
if you're video based, it's TikTok. If you're text based, it's Reddit. You know, I search on Google all the time, like, hey, I'm looking for the best restaurant here, and I add Reddit to the end of it because I know people are going to be discussing it. So like, yeah, that's the new age. We've got the market opening up at all time highs. I think that's a good transition point to some of the next questions I've got for you. You know, I'm more of a technical guy, so there are a couple things I'm noticing both, you know, technically and from a Stocktwits community perspective. Wanted to get your view from a tech side. So, you know, we'll spend 5-10 minutes on these couple ideas. The bull case for Intel. You know, the way I see it, Intel's trading back at levels it's not been at for 25 years. You know, prices have stopped going down. We've got 9 months of kind of consolidation, and now people are trying to figure out if it goes up or down from here. So even the Stocktwits community is trying to make the bull case here. You know, if you were back on your institutional desk and, you know, you had to make a call on Intel, what would you need to see to get this back in the game and as part of people's portfolio? Or is it truly kind of a left for dead stock at this point?
The Intel's problems, that the fact that, you know, they went from the apex of semiconductors to the nadir and just, you know, lost the whole thing to NVIDIA because they focused on CPUs and not GPUs, all well documented. They missed the mobile cycle. They missed everything. They almost got the automotive chip cycle with Mobileye and so on that they bought, right? And even they just announced this week they're selling off that and laying off people, etc. Look, it's a company under new management, and when that happens, and the current new CEO is a smart guy, knows tech. Really, he really does know these. He's a chip guy, and so and a deep technologist, which a lot of analysts respect. So he's got, you know, now it's a value turnaround story, and so but so that's the good news. So that's why people are looking at the stock again, not just from a short-term trading point of view, but long-term, that there's a bunch of things. If they can fix this, the foundry business, if they can actually get it off the ground against TSMC, all of those things are possible lights at the end of huge long tunnels. The problem is all of those are long-term stories. It takes years to do this, but they're positioning themselves. They're cutting employees. They're getting their cost picture better, etc. There's still a lot going on tactically and strategically around AI and semiconductors and so on, and there may be some strategic things they can do as well. So that's also in the stock. So yes, for all of those reasons, and this is not a stock recommendation, there's more things in terms of the Lego pieces of Intel that can be restructured to create a very interesting little constructs around this, and that would be very appealing, again, with a multi-year outlook. But the company is a long way from out of the woods. It's the core things they have to do, which is foundry or no foundry, all of those things. These are very long-term bets that they'll have to do. Plus, navigate the reality that, you know, if they're asked to basically build all that stuff in the U.S., that takes even longer because, you know, we don't have the ecosystem of tens of thousands of people who are trained, not just at this PhD level, but everywhere else down the chain to not just staff the Intel factories, but the dozens of Intel supplier factories that would need to be in the US as well. All that takes time. And so it's but at the same time, it's a turnaround. So people are leaning into it. And I totally understand why, both from a short-term point of view and the long-term point of view, given how far the stock has fallen.
Yeah, that's kind of how I'm viewing it as a non-fundamental guy. Just from a narrative perspective, I see that the conditions are set for a turnaround. Now, the execution obviously matters, but from the last decade, the conditions now are better to support that story than they have ever been. My biggest worry is that, given how many other stocks in the space are working, why would you allocate funds to this unless you're a pure value guy? So I think that's kind of the tactical portfolio management perspective that's going to be a headwind. But yeah, if it can show some initial momentum here, I think people will start to buy into the story.
Yeah,
There's a saying, nothing changes sentiment like price. So if we start
agreed.
to see this move into the high 20s, then the pieces of the bullish narrative that we're talking about now become a lot easier to support at those kind of higher prices.
No, well said. And look, they need to show one or two things that basically can give momentum perception to certain aspects of their story.
Yeah.
ARM, when they went public a couple of years ago, SoftBank, etc., it outperformed much higher than what the fundamental analysts said they would.
Yeah.
Why? Because they were supplying the templates for all the chips that went into mobile. Apple was a big customer, is a big customer, etc. But the economics was still not justified at the valuation ARM is today. The reason I bring up ARM is they changed the narrative that even the momentum investors could say, you know what, yeah, it may take ARM a long time to make a lot of money on their existing contracts in terms of the mobile stuff, etc., but they can build additional business, acquire things if the stock goes up.
Yeah.
And they're at that point. Intel is at the beginning of that part of the journey. And so once they say, hey, this is how we might do foundry, this is how we might do this, and we got one or two showcase customers, and besides the contract from the government or subsidies that say we can build these factories, once they start to do that, then the momentum stuff can maybe take things along, as long as the broader market is in a happy place, right?
Yeah, that's the
because
other
momentum
piece.
doesn't work if the market's not in a happy place. So
yeah,
that's the other
momentum
thing
works,
to keep in mind.
upside and downside, unfortunately.
Correct.
So,
Correct.
another
And
one on my list is Paramount Global. We've got Netflix and Spotify trading at all-time highs. Those stocks have literally been, they've gone straight up the last 2 years.
yeah,
I'm curious. We're starting to see some chatter. This is the chart of Paramount Global. It's stabilized above 10, 11, 12 bucks, and it's starting to move higher. So is this is there any room for a legacy media company in people's portfolio, or is this just something that's kind of a dash for trash right now?
no, I mean, again, these are the value plays. This is the legacy media stuff that is getting restructured, where we went from cable to streaming, and that took 10 years, and now streaming is becoming the new cable. And in this time around, the new winners are not telecommunication and Comcast and so on. The new winners are clear. It's Netflix on this side of the barbell, and YouTube, Google on the other side, and everything is also in the middle on the streaming side of the equation. All these guys are essentially they've shrunk. Their business is this is like music business, which was 100 billion, went down to 20 billion as a cumulative thing. Newspapers that went from X to a third X in 10 years because the internet and things changed it. Legacy media is the same thing. I mean, why do I need to worry about this show? Is it on Max, Cinemax, Hulu, this, that? Those are artificial constructs that made sense in a world of cable, but there are way too many brands. Everyone knows it. All people care about are the shows. And in fact, the whole marketing for the shows themselves have changed. Why? Because of a little thing called TikTok on the other side. Think about it. TikTok basically redefined the message. Marshall McLuhan said medium is the message. TikTok made possible 30-second videos, 60-second videos. So guess what? Both legally and illegally, most of the shows that you would know and like or not like got recast into 30, 60-second clips, which exposed to 2 billion people. And all of a sudden people said, oh, you know what? These clips of Suits looks cool. So, and Suits then becomes the hottest property on Netflix because the Netflix executives are not stupid. And they're like, oh yeah, Suits is the big thing on Netflix, on TikTok. It's blowing up. People are really, they're watching all this. So they go get the license for Suits and promote it as the top 10 on Netflix. It becomes the hottest new show again, and now it gets extensions.
Gets a second life with a new audience.
Exactly, and the Paramount Globals of the world, they've got the classic incumbent legacy players. They've got a foot in one door and a foot in the other door, and the majority of the bread is still butter on the traditional side. Yeah, their value proposition has shrunk. They've gone from being worth 10x something to a third X. You look at Viacom, Sherry, who's doing the horse trading on her assets. she went from being worth 20 billion to less than 2 billion in the value of her assets in legacy media. Sumner,
and quickly too.
And very quickly. And that's the impact of technology on media. It's just that these brands that we're looking at is a part of that broader picture. So Paramount, yeah. So it's Paramount, Disney. All of these guys have to figure out how to, and they're moving the pieces around. Some could say they're moving the pieces around the deck chairs on the Titanic. I'm not that bearish, because ultimately anything has value. It's just that once it's part of something or you spin it off, then investors anew can say, is this is a viable business here by itself or not, and then make decisions as a value stock or a growth stock.
Yeah, a lot of these names have just, they spent the last 3-5 years like cutting costs as much as they can. They're as lean as they're going to get in many cases.
Correct.
Now it's a matter of, do we break it up? Do we sell it as parts? Do we, try to make 1 or 2 growth bets here? So to me, I know Shai's got his, new age tech basket. Maybe I've got my old age tech basket. I'll be the boomer of the show. But
no, I love it.
I think all of these are, they're starting to see an uptick of both price action and chatter. And I think a lot of people are discussing the thesis that we are right now. Last thing on the tech side, platinum and palladium. I mean, precious metals have been the trade of the year in many cases. Gold trading at all-time highs, silver at 14, 15-year highs. Platinum and palladium hadn't really done much. But now they're starting to get going the last couple of weeks. Is there a fundamental reason here? Like how big of a role do those play in tech? Are there, how much of the tariffs is driving this? What's your view here?
Well, platinum and palladium, unlike gold particularly, I mean, they have industrial uses, manufacturing uses, etc. So there's that component in that which has applications in tech, obviously, but also broader on a lot of other products and services, etc. So it's never been kind of viewed as an inflation hedge necessarily, but it tracks both on its industrial use and its metals piece of it in terms of as an alternative to gold and silver, etc. And so because of those dynamics, I think it's a more complicated picture than the easy ones like gold and Bitcoin, which I remember because Bitcoin is supposed to be the digital gold, and you've seen the volatility in Bitcoin just on that side of the equation. And then the last thing I'll just point again, I'm sorry I keep coming back to the macro, but our first half of our conversation weighs on me in terms of what the macro looks like over the next 12 months. So when I look at metals or anything, energy, in the context of what macro picture we've got in the next 12 months, I'm like worried, okay, if platinum and palladium have industrial uses, well, I haven't done a deep analysis of which industries and which specific, autos or whatever it's going into. Guess what? All of those are going to be not seeing the growth rates that we would have seen in a normal world of 10% tariffs. And if that's the case, platinum, palladium go into manufacturing, all the subcomponents, all the stuff that's being traded between Canada and us, Mexico and us. Remember, the average a U.S. auto company basically ships the same pieces of the cars back and forth to Mexico and Canada a bunch of times. And under a lot of these rules that are changing every day, week, month, depending on what the White House decides to do, guess what? The platinum palladium cost gets tariffed on top of that. If that's, it becomes very tough. The same thing's going on with, the steel tariffs that we just put on, right? That's the bigger metal. I just pointed out, but, ask any steel analyst what they think. And of course, all the steel stocks have gone up, the US ones, but everyone knows that that's a short trade because that just means our markets are captive to the US steel prices. They're going to raise their prices. The steel companies will have a short-term thing. So yeah, everyone knows it's going to go up, but they know it's going down too. So the hedge funds are positioned on that.
Off.
Of course. And that's what matters. So it's short-term versus long-term trading, and that's part of the puzzle. And right now, I'm not an expert on platinum palladium, but I'm just saying the catalysts for a momentum trade on either way are still a little bit in the gray area. is
Got
probably
it.
what's going on, is my sense.
Yeah, to me, it almost fits kind of in that value bucket, right? Like if you don't want to
Correct.
buy, gold or even copper's, trading at all-time highs. If you don't
There you
want to
go.
buy those, you can buy platinum, palladium for kind of a catch-up trade and see where it goes. So I think, that's a lot of the sentiment we're seeing.
No, copper you
Um,
bring up, I'm still watching catalytic converter thefts around the country, and those numbers are still high.
yeah,
I'm watching that as a track because that's exactly what you're talking about. People are ripping these out because there's value in organized systems to rip out these things from your car parked on the street and sell them for
yeah.
2x or 3x.
That's a great
Yeah.
one. I'm gonna see if we can get that added to the show each week. The catalytic converter index. That would be great. The most obscure things that we can think of here. All right. So I know we've got 15 minutes left. We've got a lot of stocks moving in the market right now. A lot of them are, we have Big Bear AI. We've got a lot of small and mid cap stocks last week really catching a bid. I don't want to dive too big into those. If you guys are wondering why they are trending, you can hop over to Stocktwits, use the trending bar. It'll give you a full explanation of why they're moving. But I know you had a few kind of topics you wanted to discuss here on the AI side. So let's get into Meta and what they're doing. Reports over the
Sure.
weekend, basically Bloomberg and the information saying that they have hired 4 artificial intelligence researchers from OpenAI to join its superintelligence group led by Alexander
Yep.
Wang. So this seems like
Yeah.
a massive investment. What's your read on it?
Yeah, so I've done a couple of posts on my Substack the last couple of days, just yesterday as well, which is that the Mag 7s and everybody else around them, anyone who's investing in AI, the biggest, in addition to AI GPUs, which are a supply constrained from NVIDIA, et cetera, one of the other major input constraints has been AI research talent. Why? Because AI technologies are being ferociously invented and reinvented right now as we speak. In my 30 years of watching tech waves, I've never seen, even 3-4 years into this AI wave, is where the demand for smart researchers to do the work of recrafting the technologies, the demand for those people has never been higher. That supply will increase over time. And by the way, most of it is going to come from China and India, but that's a separate piece. But currently, the OpenAIs, NVIDIAs, Meta, they're all Elon. Speaking of Elon, because he has Grok, they're all ferociously competing for the few hundred top brains on the planet that are AI researchers. About half of them tend to be Chinese Americans and Chinese. And Jensen reminds us, half the world's AI researchers today and tomorrow for the foreseeable future are from China. He himself was born in Taiwan, as an example, right? The CEO of Broadcom, born in China. Amy, head of AMD here, China. And my point is, what Meta is doing is just the headline. They are spending $70-80 billion in AI data centers, which are huge numbers. The numbers that they're going to have to spend for AI researchers, yes, the individual numbers are eye-popping. Sam Altman talked about his scientists being poached by Meta, by Zuckerberg himself personally, emailing these people,
reaching out.
because he's a ferocious founder CEO. You got to respect that. He just, when he's like, he reminds me very much of Bill Gates, and I used to track and follow in Microsoft's efforts in online in the 90s. He's the next Bill Gates from a ferocity point of view in terms of building. And his view is, if I can't build whatever the next thing is, I will buy it. Notice what he did with Instagram. He bought Snapchat. He didn't buy it. He stole Snapchat because he couldn't buy it. He took the Snapchat Stories product and made it part of Facebook and Instagram, etc. He always does the build versus buy, and he if he can't buy, he will build. So that's on the AI side. He is opening up his checkbook. The $14 billion, $15 billion acquisition of Scale AI was a sounding gun that says, yeah, we're in it for business. And the 4 people that you talk about all happen to be Chinese Americans, actually. NVIDIA just hired 2 of the top. I wrote about it this yesterday. Google just hired a couple. So there's a ferocious bidding war that's going on, which individually sounds like it's, sports, like a baseball contract or a basketball, $100 million signing bonuses, etc. But when you aggregate all of that, it's a pittance compared to the 70, 50, 60, $70 billion each of these companies is spending a year from cash flow to fund their AI efforts. And by the way, Meta also made a big announcement this week, which is notable for investors. For the first time, one of the big Mag 7 companies, Meta, is actually in the market to raise about $30 billion in debt and equity. They have an amazing balance sheet. They can do this. Why is this important? Because until now, Microsoft, Google, and Meta, these are the three companies with amazing cash flow, right? Meta and Google from advertising, ungodly amounts of money, tens of billions of dollars on ad revenues, because they're the two biggest. And they've been funding it through just, money coming in the door and write checks. Now they're saying, okay, we're going to use our balance sheet to raise debt against our balance sheet, and we'll take it up to 100, 200 billion, whatever we need. These are trillion-dollar companies. They can do that. And that's important because what they're saying is we're not funding it from cash flow. And that means that they're running at the edge of what investors are going to tolerate to take of their cash flows in their capex budgets. They're going to fund it through these debt instruments, direct and indirect. And all of that is huge powder for Zuckerberg to buy whichever scientists or researchers you want. And by the way, when you see $100 million price tag for the top researchers, guess what? The bottom AI researcher who was being paid, let's say $500,000, his or her pay goes up $1 million to $2 million. That's what's going on OpenAI. If you look at the other note, the OpenAI management just put out a memo internally saying, hey, don't worry, guys, we'll take care of all of you. We'll have to relook at comp.
So guess what? Don't go anywhere.
Don't go anywhere. So look, I've seen this countless times in tech, not at these kinds of numbers, because the AI wave is bigger than the PC wave, the internet wave, the mobile wave, the cloud wave. So the numbers are bigger, much bigger, but it's the same game. And it doesn't end for now, because there is no ceiling to the amount of development that we can do with AI to create new products and services, which we've not even begun to really build at any kind of scale. So this is a new part of the landscape. Meta is the aggressive, quote, drunken sailor, if you want to call him that. But there is method to Zuckerberg's madness, if you want to call it that. Everyone's going to have to ante up. The overall numbers are not huge in the scope of what they're already spending on infrastructure. So the headlines will look very, I wish I was an AI person. I wish my kid was studying AI. But guess what? All of that will normalize too. In 2 or 3 years, there's going to be enough AI researchers. There's going to be enough everything. I remember this, in the mobile wave in 2000s, when the iPhone came in 2007. For the next 5 years, because I did a couple of startups back then. If I wanted mobile developers, I was having to pay 2 to 3x market. Same thing. Not these kind of zeros, but still zeros, uncomfortable zeros. And same thing. And demand, supply catches up. And a lot of the supply, by the way, is not just in the US, but from China. India is ramping up. India and China each are putting out more STEM graduates a year, 2 to 3x, depending on how you count it, relative to the US. So there's a lot coming from there. And that's another piece that the US government needs to keep in mind, because one of our most formidable industries, exports, is our education system, our college system. Over half our students are from over there. They pay market rates for tuition, and a third, half, depending on their luck, they end up getting green cards, and they ended up living here and not going back, and they become the next Satya and Sundar to run our tech companies. So immigration, our support of research, in terms of colleges being able to invest. I mean, the internet wouldn't have happened without the government funding. Mark Andreessen himself says, if he didn't have the one of 4 supercomputers at his university, he would not have invented the browser in 93, 94, and he wouldn't have become now running $50+ billion of venture money in Silicon Valley. So
super interesting.
So it's all intertwined, and so that's the broader context on the Meta spending, which is, I think, a signal that this is this is going to continue for a little bit.
I believe it just opened at all-time highs. So clearly the market is liking what Zuckerberg's doing. Your point about like these big market teams having these war chests and getting talent. I wonder if there's a startup out there that will adopt like a Moneyball type strategy, or they'll find undervalued AI researchers and build a team. Who knows?
No, you don't even need Moneyball. I'll tell you where they are. They're in China. In a normal world, Apple and NVIDIA just expanded their facilities in China because they can hire at 10 cents to the dollar AI researchers in China, dollar for dollar, as good as anything here, at a tenth of the price. There's an arbitrage. I wrote about this in a post. Because again, when Jensen tells you, listen to him, half the world's AI researchers are in China, coming out of China. Okay, that tells you where to go. So I don't even need Moneyball. I just need to just get on a plane, go and hire, with $1 billion and say, okay, I'm gonna. But I can't do that today. Why? Because the U.S. government says, oh, China is geopolitically an enemy. They're worse than the Soviet Union ever was. Blah blah blah. They're gonna steal this and steal that. No, Chinese entrepreneurs, the whole CCP and communist. I guarantee you, Xi Jinping barely knew what DeepSeek was before DeepSeek got to the attention of the world's researchers. It surprised them because it was just a hedge fund guy who funded this thing because he was a billionaire. He could fund the damn thing for $1 billion, and he did. And he bought the legal NVIDIA chips mostly, and he created an open source large language model that crushed almost everything, including what Meta was doing. The reason Zuckerberg's feeling the heat is because until a year ago, his open source Llama software was the cat's meow in open source large language model, best of the breed around the world. Now it's in the middle to the bottom of the rankings. And by the way, OpenAI is about to announce, and Sam has been hinting at this, his own open source strategy on his models. So Zuckerberg knows competition's coming. So, and he doesn't have an AI strategy without that. So this is all. So if he's building the factories, he has no products for the factories. He needs a solution. That's why spending a few billion dollars for a few AI researchers is a great deal, is a cheap deal for him.
All right, you heard it here first. Billions of dollars for AI researchers is the best deal
cheap.
In town.
It's the best deal in town.
I gotta
and
go.
And you want it even cheaper, go to China.
I gotta go sign up for some college class and become an AI researcher. Let's see.
It's all online. 2 years ago, I signed up. UT Austin AI, 6 months course. Stanford has it. MIT has it, and there are pittance, and a lot of them are free. You can do it in your spare time.
I know what I'm doing this weekend when I have the day off for 4th of July. So, all right, we've got 2 minutes left. The market is, obviously hanging out near all-time highs. It's a big week, for economic data. We've got a lot of the U.S. employment data coming out. We'll hear from Fed Chair Powell tomorrow speaking. So yeah, a lot of movement on the employment side this week. Honestly, I don't think there will be all that much happening. We've been watching initial claims, keeping an eye on that for an uptick of layoffs, but hasn't really moved the needle all that much. And we had the Fed meeting 2 weeks ago. They basically renewed the stagflation fears by ramping up their inflation expectations and lowering their growth forecasts. So that's going to be in the back of everyone's mind. But honestly, I think what's top of mind right now is people heading to the beach. We're hoping for a slow, quiet week, most of us, and we'll come back next week and have the second half of the year ready to go. But,
correct. 4th of July, it's our penultimate birthday as a nation before our 250th birthday next year. Next July 4th is a big one. And it's historic. It's historic. It's the 249th year birthday. So
you got to eat 249 hot dogs. That's the way to go. That's how to celebrate.
Yeah, it's our penultimate 250 birthday mark. So I'm going to try and celebrate a little bit of that because that's a big deal. We get to be almost 250 years old, which is awesome.
That's awesome. All right. Well, thank you, Michael. Appreciate you joining us for this hour. I learned a lot. I know the audience did as well. We'll be back tomorrow with Katie and Shay, and I'll see you guys again on Wednesday. But enjoy the rest of the trading day, and see you guys soon.
Tom, thank you for pitching in, and it was great.
Of course.
Thank you all.
Talk soon.
Have a good one, guys.